Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Matt Komos, Vice President of Research and Consulting with TransUnion, to discuss TransUnion's first quarter industry insights report, examining credit trends 1 year after COVID-19. And it shows that the consumer credit market is strongly positioned following the first quarter. Matt, it's great to meet with you. Welcome to Trade Talks.
Thanks so much for having me, Jill. Glad to be here with you.
Thank you. And give us a high-level overview of what this report covers.
So our industry insights report takes a look at, lending dynamics and kind of trends in the lending industry. So we get a good view as to what's happening with the consumer, as well as how lenders are kind of approaching the marketplace. And what we've been seeing is generally consumers are doing pretty okay when it comes to credit. There was obviously a pullback when the pandemic first took hold. Many lenders were kind of skittish about providing money to consumers. And actually we saw some demand drop off. But what we've been seeing more recently is a return of lending and a return of interest from the consumer. As consumer confidence starts coming back and unemployment continues to improve, consumers feel better about taking on additional debt.
Are you seeing increased loan activity in auto, mortgage, and personal? Have origination levels returned to pre-pandemic levels?
So we're not entirely at pre-pandemic levels for products such as auto or credit card or personal loans. Mortgage, however, has been gangbusters. As you can imagine, with such low interest rates, many consumers have taken advantage of this as an opportunity to refinance, maybe take some cash out, put that in the savings account, and have that available as a cushion. As well, you have many consumers that might have been thinking about buying a home, but it was too expensive. Well, with those low interest rates, even as home prices continue to go up, we've seen a lot of purchase activity. Now, on the personal loan, credit card, and auto loan front, we have seen a rebound. So even though it's not back to pre-pandemic levels just yet, lenders have been getting back into the marketplace, and consumers are starting to, originate new loans of these products. And it really depends, right? So for some consumers, a personal loan is a great option to do some home improvement. They're working from home all the time now, and that bathroom that they've been kind of looking at and not liking, all of a sudden it becomes a good option to go out, get a personal loan, and do that home renovation.
How are delinquency rates in this backdrop of loan demand, prudent lending measures, and stimulus checks?
It's really been an interesting dynamic. Many lenders, when they come to talk to us about, okay, what are you seeing, or how are things playing out, they often refer back to the last recession, right? Because up until now, that was kind of a benchmark that many lenders think about with regards to economic collapse. This has been very different. So first and foremost, the government response has been kind of unprecedented in terms of stimulus payments, unemployment benefits, and these types of actions have helped keep delinquencies really in check. So we're not seeing delinquency levels really come up at all on any of the major product categories. This has also been aided by the fact that, many lenders have been offering accommodation programs. So if you're struggling, if you're unemployed, you might not have to make your auto payment or your credit card payment. And for some consumers, it's been going 3 months, 6 months, if they haven't gotten a job or hours replaced at their hourly job, they all of a sudden don't have to make those extra payments. So it actually effectively adds cash to the consumer's pocket. So it's been this different dynamic than what we saw. And remember, the last recession, housing was at the crux of the economic collapse. This was a completely different exogenous factor. It's a global pandemic. Housing is actually doing phenomenal in many markets. So it's a very different type of kind of economic disruption that we've seen. So again, delinquency numbers are looking pretty good as of right now. The question becomes, when those accommodation programs end or consumers come out of mortgage forbearance, how will they pay their bills?
And that was my final question to you. Do you think consumer behavior has changed for the long term as a result of the pandemic?
I mean, there are probably many behaviors that will likely shift. One aspect will probably be, the kind of willingness to transact online or digitally. We anticipate that this, trend that was started before the pandemic will probably accelerate because many consumers were forced to do other shopping online or to do, a lot of their transacting, banking, lending options, everything was done digitally. So I think that will probably be something that's here to stay. Then the question becomes, is the consumer going to come through this period in an overall better financial cash flow position, which will, translate to hopefully increased consumer spending, right? We're already starting to see some of that come back. That is likely what will help drive economic recovery. The question becomes, with all the pay down in debt we've seen over the pandemic, does the consumer say, I'm going to stay away from debt? Or do I come back, does the consumer come back as vacations return, as big ticket purchase items return? That's yet to be determined, but we'll see kind of how that plays out.
All right, Matt, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much, Jill.